Welcome traders to the next video of supply, demand and order blocks. In the last one you've learned the theory behind it. In this one we will go and put it into practice. Just a quick reminder, whenever we are watching or looking for a supply zone, what we want to see is an up move candle, and in most cases that one up move candle is collecting liquidity, and afterwards the market is dropping to the downside. So the reason for that one up move candle was actually to generate that liquidity, to take out the liquidity in order for the big institutions to be able to bring the price to the downside. And this is why our idea is that the price will return to this area again in order to close these buying positions. As we know, institutional traders do not use stop losses, so they are just taking the loss with them with that one down movement, because they are in big profit, right? Because they brought the price to the downside, and by breaking structure, which is the second thing that we need to look for in order to confirm our zone, they are showing the institutions that the price is bearish and that everybody should look right now to add short positions. So they've been creating that one structure, they've been creating the supply zone, and they would like to return to that area in order to close their buying position, and then afterwards they are here to drop the price crazy to the downside so that they can make even more profit out of this kind of thing. And a demand zone is a short movement to the downside, collecting the liquidity, and afterwards we have a strong up move. Okay, let's put it into practice. Now in this case, guys, what we can see here is pretty clear. We got that one up move candle that we talked about. We'll monitorize it then on the lower time frames to see what this up move at the end really did, and then price started moving to the downside, and you have your break of structure. Now in this case, what we do not have is we do not have an imbalance, fair value gap, or market inefficiency. You can call it whatever you would like to call it. And this is just for us an additional confirmation to find these imbalances, because price needs to come to fill them in order to allow every buyer and seller a fair chance. This is why we also call it fair value gap. But it's not absolutely necessary, okay? And more than likely on the daily time frame you will not even find them very often. Sometimes you will, sometimes not, okay? So everything, every rule is here filled. So this is a valid supply zone for me. As we can see, price is returning to it and start dropping. That's the idea. Now, how many traders are using it is they put their entry there, put their stop loss above a little bit, and take profit to the next structural point, and you have an incredible 4-hour trade. Okay, this is not what we are looking for. 4 hours is really nothing. What we are about is we are looking to refine these zones. Okay, so we will switch down to the lower time frames to refine these. But right now, let me just map out everything on the daily, what we can see. Now, after this market dropped even lower, so it broke your additional structure in this case, here we can spot a supply zone which failed actually. So this one here was also a valid supply zone. In this case, this supply zone failed. Okay, so not always when you will see a supply zone or a demand zone, it doesn't need to always be successful. In this case, we had other reasons why this did not work out, and this is why me personally, I didn't even use this one as a supply zone. Quick understanding thing, we had liquidity here, which we will go over in the next chapters. So because of you have liquidity here, you should always be aware of if you're mapping this out, because liquidity is always being used, and in this case this was used to dive into this supply zone. And if you understand everything, then you know exactly why you should not use this one over here. And this is more about how to qualify the right supply and the right demand zone. but it's not important right now for our example. We just would like to go over the theory right now, just to understand what we need to do. Okay, now you can also spot here another breakup structure, which makes this demand zone over here valid. So it's the last down move candle. As you can see, price reacted pretty nicely to it, gave us another move up. Now what you can see here is that the price broke structure here, price broke structure here. So we have here two breakup structures, which makes this kind of thing here valid and is our new supply zone as well. Then price dropping here lower after reacting to this, okay, dropping lower, breaking another structure over there, which makes this supply zone valid, and currently this is where the price is dropping. Very, very easy. Okay, now we defined them, and I think it's not rocket science right now to just map out these order blocks, these supply demand zones. Our next job right now is to refine these and to go to the 4-hour time frames. So I've already covered them up, so let's just go over them. Now on the 4 hours, and the lower you will go, the more order blocks you will see, and the more difficult it will be for you to qualify them at the end, because you will just see only order blocks at the beginning, okay? But I will go over that also in the next chapters. Right now our job is just to qualify them based on our rules that we have, finding imbalances, finding breakup structure, and finding actually if this price really took out liquidity. Okay, it's super important for us. Now let me just go over the daily. Now the daily is actually this one, right? It's this strong up move candle. You can see only bullish candle within that range on the 4-hour time frames. And what you can see is that we had here liquidity. Okay, so we had here already liquidity, and with this up move we cleared out this liquidity, and this is why the price then dropped to the downside. And by looking into this supply zone, we can see another up move candle, and then price dropped strongly to the downside, and with this drop the price broke structure here, it broke structure here, okay, and then it went lower. This one was broken afterwards, after the price gave us another strong move up, and this move up cleared out liquidity from here as well and dropped lower. So this is why I qualified this one here again also as a supply zone, because it took out liquidity. This is actually for me the real reason why I'm looking for that on up move candle, and not only because I would like to see an up move candle before that a down movement will occur. No, I would like to see price really taking out some liquidity, and this is liquidity here, okay? Here, this is liquidity, okay? And this whole thing took this liquidity out. So it's completely fine. Okay, then price broke structure. Let's go lower. So we can use definitely this one, and we can definitely use this one. Our job right now is to wait for price to come to test this, and we can take immediately our trade, or we're splitting it into half. So we're using Fibonacci, use the 50%, and you can then use actually your entry you can put here, put your stop loss here, put your take profit till the next structural point. That's, for example, one trade setup that you can take. This one, or you put it even lower depending on how you determine your target afterwards. The best is always to put it to the next structural point. This is one possibility, or the second is you put it over there at the middle, should be your entry. In this case it was not triggered, or you put it sometimes a little bit lower. That's also possible. That's what I do often, because price will not always tap it exactly in the middle, so you're just using your mathematical methods to just part it into two, and therefore you can split half of your risk for this position and half of risk on this position, and you can use both ones if you're not sure about it. The best one is always to use this one here. Why? Because you will get additionally more risk reward, because you're going to capitalize on this half as well. Plus, if this setup will fail, this one will probably go through and you will be successful. And if it will always take this one as well, then you're always risking to lose a position before the next one will probably make profit. But if you will only use this up zone, then probably you will miss some opportunities. But if this zone is right, then you will definitely capitalize on it, and you will not need to take a loss before you will capitalize on it. Okay, so that's the theory behind it and how to use it. Okay, so very simply. Okay, well, that's basically it for this example here. Price drop to the downside, and you can actually define more and more supply zones. So for example, also here one, you got another one, right? Price broke pretty nice structure. Okay, and overall with this whole movement, the price was generating liquidity. As you can see, price peaked up, down, then another move up, and then finally dropped to the downside. And this is within the lower time frames. You will see here more things based on liquidity concepts. Okay, so okay, this one was good. Price dropped. In this case, clean entry. Look at this. Imagine taking over here the 50%, for example. So mapping out this one, taking 50% of this range, putting your entry here, stop loss above, and then capitalizing huge profit. 31 risk reward, for example, would have been possible. That's just the theory right now behind it. So that's not ultimately our entry style. Our entry style for this one will only fit if the liquidity is okay. In this case, liquidity was definitely on point because price actually went above this one as well, then dropped. That's good. Let's go back to the zone which we defined here early on. Look at this. Getting an entry here or getting entry at 50%, and price is dropping. While it's dropping, it created our new zone, right? Okay, that's what it created. And we could have been capitalizing when the price returned over there as well. So it's the same kind of thing. So look here. By refining this daily demand supply, up move candle before price dropping, it also created here on the 4 hours something, right? Created over here. From here, the movement started to the upside. So let me just explain you this kind of thing. Important for you is always to use the real up move. Okay, and the up move also includes the wick of this bearish candle, right? So don't use only this one. This is risky. Using only this can lead into many losses. Using this, it's correctly, because what you see here, it's the 4 hour time frame. If you will monitorize these two candles on a lower time frame, then it will look something like this. Okay, and this whole uptrend here is generating liquidity on the downside, okay, which will be targeted with this move down. And this is at the end our supply zone. Okay, very important, guys, very important. Don't forget this. Okay, entry there, and price drops. Then same thing, supply zone here on the daily. Then here you can use the last up move candle. Here you can use this, okay, to make it precisely. This is the last up move candle. Boom, price dropping afterwards. Crazy entry, okay. And you can see price is repeating it again and again. It's always doing this kind of thing. Look at this. Creating another supply zone here, because this here price broke structure. So I think it's clear, that concept is not really difficult. Let's go into the demand zone to clear out the demand zone as well. So price broke here structure. This is what we define this kind of thing to be the daily. So you can see this is the strong down move. This was the down move which took at the end the whole liquidity from here and took out liquidity from here. So it's, look at this, exactly from here the movement here on the right side occurred. So this is what makes this zone valid. And what we look for here then is actually, you look for the last down move on the 4 hour, which is this one, before the up move occurs. And here you see again the same characteristics. You see break of structure, first place. This is break of structure, sorry. Just make it more clearly. So you got this break of structure and you got this one here as well, of course. Plus you got market inefficiency, okay? Don't forget this one thing as well. This is the market inefficiency. So this is also created over there. And this is why the price at the end tapped into the zone and went even into the demand zone pretty deeply. So you could have been using here as well the 50%. So this is then really up to you how you would like to manage these things. Me personally, I'm using it with liquidity, which I will explain later on the chapters, like I already said, how I will really get my entry at the end. And this game can be repeated right now, guys, okay, on every single time frame. You can refine it even on the minute 5. You will find a ton of examples over there as well. So if I'm going here, minute 5, so it works a little bit different sometimes on the minute 5, but let me just map out some of for you. Look at this. So you had this one, okay? So you have a little bit of fake outs, okay? Be aware of fake outs. This is why my stop loss is always a little bit above it, okay? Because this is how they can get really the maximum out of it. Then look at this. Last up move candle. Price took this one. Then here, last up move candle. Here in this case, if you have something like this, always use then the red body to take it. It would not make sense to take this whole thing. Just take this, okay? Good example. Okay, so here right now, guys, I do not qualify them. I just gave you right now what is the real. So what I would like to see is always break of structure. And here you got break of structure, okay? So you got break of structure. This one here created break of structure here. This one, okay, this is my Alexa, sorry guys. Here, for example, price broke structure there, so it makes this kind of thing here valid. Price never tapped into it, or did it? If I'm using this kind of thing, almost tapped into it, but not really. Sometimes, which will occur as well. And then look at this, price broke more structure to the upside, and then it's going through it. But in this case, the whole situation was bearish, and we are coming from a daily supply zone, from a 4-hour supply zone. So looking here for demand zones would not even make sense, okay? So you should always look there for supply zones. Yeah, and you can repeat this whole process. Look at this, another one, supply zone. Then here in this case, price just only took liquidity, but it's still the same supply zone over there, but went a little bit higher, but still the same one, okay? Then here, perfect demand zone examples. You can see here, price broke structure. This is my demand zone. I think that this concept is clear for you guys, okay? It's really not difficult. So what you always would like to see is a clean break of structure. And like this, don't use this as a break of structure. Use this as a break of structure, because this is the real structure, right? This is the real structure. This is then the real break of structure. This one you will identify every single minute, and this is why this is nothing worth it, okay? So don't use this. Use this. Okay, well guys, that's basically it. Hopefully you got this concept, you know how to draw it, just how I proceed. Always I'm starting with the daily, okay, sometimes weekly time frame, depending on if I'm just analyzing it, because weekly time frames for me just analyzing perspectives. On a weekly time frame, I will not look to buy from a weekly demand, of course not, but I will look if I will find on the weekly time frame a daily demand, and then in the daily demand I will look for a 4-hour demand, then a 1-hour demand, and I can refine this kind of things and combine it with structure, liquidity, and stuff like that. Okay, So thanks for watching, guys. See you in the next chapters.